Good afternoon, everyone. We'll go ahead and get started. Um, Thank you for joining this afternoon. I'm Zach Myers with the Center for Dairy Excellence. Thank you for taking the time to join our Protecting Your Profits webinar today. If you have any questions, please type them in the chat box by clicking on the chat box at the bottom of your screen. I will monitor those, and we will hold all the questions until their Q&A system, where we have Sam Miller here from BMO Harris Bank, who I'll be introducing more in depth here in a few minutes after I get through my slide deck. And so we'll hold all these questions until the end of the program and have a formal Q&A after that, and we'll go from there. So my goal today is, just like every month, is to provide an overview of the current dairy markets and to review risk management opportunities. The information I've put together is all public information, and while I may express some opinions, these are certainly not recommendations. So we'll go ahead and jump into this and leave as much time as we can for Sam after I'm done. So March milk production and cow numbers at over 17.5 billion pounds. U.S. milk production was down almost 1% year over year. And then do I have, let me see here. Yeah, I've got the right thing going on here. U.S. cow numbers were down year over year for the fifth month in a row to 9.4 head. It's about 1% down, about 87,000 cows down from the beginning of the year. And this is the second month in a row to show a month over month increase. So since, which is it's 15,000 head more than last year's. Pennsylvania lost another almost 2% of cows in March, down to 467,000. This is 8,000 head down compared to last year. Dairy cow slaughter was down slightly compared to last March to 297,000 head. Butter at 283 million pounds. The butter stocks are down 20%. Cheese stocks are down about 1% to 1.46 billion pounds. And then the February non-fat dry milk powder is down 7% to 289 million pounds. At $2.80 per pound, February butter price is $1.08 higher than last year, and is considerably cheaper than the global dairy trade and EU butter prices at $3.23 and $3.24 respectively. Cheese price is up 51 cents compared to last year, and is also a discount compared to global dairy trade at $2.91 and the EU at $2.56. Non-fat dry milk is 68 cents more than last year at $1.85. This is slightly lower than the global dairy trade price of $2.06, and that's comparable to the EU price skim milk powder of $1.82. So Oceania and the European Union continue to experience year-over-year declines in milk production. So that's helping to, it's driving the international price up and keeping U.S. dairy prices favorable to the export market. February dairy product production, butter production was down 27 million pounds compared to last February to 183.6 million pounds. February cheese production was up 6%, or about 66 million pounds to 1.1 billion. And then the February powder production was down 7% to 13 million pounds compared to last year to 171 million. Moving on to disappearance, and which of course is an indicator of demand. The latest data available is February. Butter disappearance was down 16% in February to 146 million pounds. Due to a large decrease in domestic use that overwhelmed a nearly 50% increase in imports. At 450 million pounds, American cheese disappearance was up 7% because of increased domestic use and exports. Then other style cheese disappearance was up nearly 7% to 653 million pounds. And this is driven by increases in domestic use, while exports were basically flat, just up just a very little bit. Milk powder disappearance was down about 5% to 207 million pounds, driven by decreases in both domestic use and exports. And so now moving on to the class 3 and 4 futures. Class 3 milk futures for the next 12 months were up 26 cents compared to this time last month, to average $23.42 a hundredweight. And this is based on April 25th closing prices, Monday's closing prices. Class 3 peaks in June at 24.82, then falls into the 21s to around $21 by early next year. The current class 3 12-month average price is $6.59 more than the 5-year average of $16.83 a hundredweight. Class 4 price peaks this month at $25.30 and then drops to the low of 24s through early fall, declining to around $22 early next year. The class 4 12-month average fell for the first time in several months compared to the previous month. At $23.70 a hundredweight, the 12-month average is 48 cents less than this time last month, but still $8.21 a hundredweight more than the 5-year average price of $15.49. So moving on to exports. Exports were down for I think the third or fourth, maybe fifth month or third month in a row here. 1.4% year over year, down about 2,500 metric tons to 175,602 tons of milk solids equivalents. Its increased cheese, butterfat, and lactose exports nearly offset powder declines, but unfortunately, the powder decline was enough to have a year-over-year decrease. Despite this decrease compared to last year, it's a record volume for the month of February for cheese. And then the value actually, even though volume was down, value was up 22%. It's up an additional $126.6 million to nearly $700 million for the month. And this is mainly driven by those cheese and butterfat products that are higher value products compared to powder. So moving on to risk management. The February dairy margin coverage margin was announced at $10.98 a hundredweight, which of course does not trigger an indemnity at any of the coverage levels. March margin will be available Friday, April 29th, after the ag prices report is released. So this is the first time I've been able to announce any kind of enrollment numbers. They just have started once the enrollment period ended. They started reporting their weekly reports. So the United States ended up with 17,560 dairies enrolled. This is about 47% of total dairies, and it's covers about 157.2 billion pounds of production history that's actually enrolled, which is 69% of total 2021 production. Here in Pennsylvania, we had 1,682 dairies to enroll. This is 27% of the total and represents about 5 billion pounds of production history, or about half of Pennsylvania's total 2021 production history. So comparing this to last year, U.S. participation is down by 4%. Or about 1,500 dairies, a net loss of 1,500 dairies not enrolling in the program. And production history was down about 3%, or about 5.5 billion pounds. Pennsylvania participation is also down, but not quite as much. There was a net drop of 36 dairies compared to 2021. And then production history enrolled is down about 100 million pounds, which is roughly 2% as well. Which is not surprising, considering the DMC project during the enrollment period did not show any potential payments. However, the floor price, the U.S. all milk floor price, it sets is still really good. So a lot of folks still decided to sign up for that safety net. So looking at the projections, as you see here, that there's still no payments projected this year. However, it would only take about a net drop of $2, either by rising increased feed prices or falling milk price for the DMC to start triggering payments again. I believe there's considerable risk for feed price to continue to rise with all that's going on internationally. And now that milk price seems to be correcting a little and starting to fall, maybe where will the bottom be this year? So moving on to dairy revenue protection, the DRP prices shown here are based on April 25th closing prices. 100% class 3 95% price protected floors can be set from a low of 18.81 in the Q3 of next year to a high of 22.91 in Q3 of this year for an average price of 54 cents a hundredweight. The floor prices for Q3 2022 to the second quarter 2023 are all in the 100th percentile of their respective quarterly 5-year average prices, with the Q3 2023 protected price in the 80th percentile. Class 4 protected policies can be purchased at floor price from a low of about $18.67 in Q3 of next year up to $22.92 in Q3 of this year for an average price of 66 cents. These price floors are all in the 100th percentile of their respective 5-year average quarterly prices. Class 3 and 4 premiums continue to be pricey. However, I would encourage you to take a look at the net floor price that the program sets compared to your break-even cost. And because they currently, even though the premiums are high, they still set relatively high Class 3 and Class 4 prices if you're interested. So these policies, Q3 2022 through Q3 of 2023, will be available through June 15th of this year. And then after June 5th, it'll shift to Q4 to Q4. So just a few stats on dairy revenue protection before I introduced Sam Miller and we move into his portion of the program. About 41 billion pounds of milk are covered in the U.S. by just over 2,500 policies. And of course, none of those policies as of yet have been indemnified. There's been about 500 million pounds of milk covered in Pennsylvania in 308 policies. And again, no policies indemnified. And with that ends my portion. I'll go ahead and introduce Sam here. I'll tell you a little bit about him and let him get into his part. So Sam Miller is the managing director of agricultural banking at BMO Harris Bank, where he manages and leads production agriculture and agribusiness related banking activities. Miller has over 38 years of ag banking experience. The past 34 have been at BMO Harris Bank. He also writes a monthly AgriVision column for the Wisconsin Agriculturalist magazine, speaks at many agricultural conferences, and has been quoted by the Wall Street Journal as well as other news outlets about ag industry updates. Sam holds a Bachelor of Science degree in agricultural economics from the University of Wisconsin-Madison and an MBA from the University of Wisconsin-Oshkosh. So with that, Sam, I will stop my share and turn it over to you.
All right. Thank you, Zach. Pleasure to be with you this morning. I'll fire up my screen and start sharing, and then we can talk a little bit about the topic of the day. You asked me to talk about protecting your profits. Obviously, interest rates and inflation is a key component of that. There's a lot of drivers of inflation right now. There's a lot of supply and demand drivers. I mean, things like, well, first, let's define inflation. Inflation is too much cash chasing too few goods. And it can be driven by demand factors or by supply factors. And also government-related factors, which can influence supply and demand. So let's just tick off, this isn't an exhaustive list, but a number of things that are going on right now. Obviously, headline news, Ukraine, Russia. There's a supply chain backlog that we've been dealing with for about a year now, and it continues. We have U.S. demand, which you just talked about in terms of dairy product demand. Weather has been a big issue. whether in South America, whether in North America. Government policy, whether that's on climate, on extraction, like in terms of petroleum, oil, metals, fertilizers are also extracted goods, and regulation that has had a driver of inflation as well. Government sanctions. So when Russia invades Ukraine, Western Europe and the U.S. put sanctions on Russia and Belarus, two of our major fertilizer exporting nations of the world. So that's going to drive inflation higher as well. And then the final topic, again, not exhaustive list, but change in Fed policy. Interest rates are increasing, and they're going to be reducing their bond purchases. So that means that they're trying to take cash out of the system. Keep in mind, inflation, too much cash chasing too few goods. So if you take some cash out of the system, hopefully you can try to tame inflation. So let's walk through a couple of thoughts that I've got with regard to the topic. I'm going to kind of hit on three things. I'm going to talk about inflation first, interest rates and what the Fed's doing, and then we'll do a little shift and we'll talk about the ag economy and kind of what's going on and how these two topics fill in with the rest of the ag economy. So when we talk about inflation, there's any host of numbers that you can use. Headline inflation is the consumer price index, the CPI. And in the United States, it was 8.5% in March. Then there's core inflation, which takes out food and energy. And then there's, I'll hit it in a second, the trimmed mean inflation, which is really what the Fed looks at when they set interest rate policy. I put this graphic together. It comes from our capital markets group because I just wanted to show where the U.S. was relative to some other countries around the world. So the inflation that we're feeling right now isn't the same in every country. U.S. is kind of leading the pack. Actually, we're not. Among these particular countries we are, but you can go to Argentina where you've got 60% inflation. That's a very different market right now. But the latest consumer price index for the U.S., 8.5%, slightly higher than the Euro area and Mexico. Our neighbor to the north, Canada, a little less, only at 5.7. But you've got lower levels in the east with China and Japan and even Australia. Let's look at where the Fed wants to see this. They like an inflation target, and the European Union has the same target at about 2%. They see 2% as a healthy level. The Fed has indicated that they'll let it run a little hotter for a period of time, but the time has come where they need to tighten it down. So here's the three different types of inflation I mentioned: personal consumption expenditures on a year-to-date basis, over 6%. The core, which is food and energy, 5.5%, and the trimmed mean, which the Fed really likes. They try to take out some of the most volatile components of inflation and say, okay, really, what is kind of core inflation? And that's running about 3.5 to 3.75%. So that's the number they really want to get tamed down back more closer to that 2% number. So they're going to exercise the tools that they have, which is raising the Fed funds rate. What impact does it have? It has a big impact and predominantly on food. At the end of the day, energy costs are driving everything. Energy drives food prices higher. Food prices drive budgets to get tighter around the world. In a developed country like the United States, we don't like higher energy and food prices, but to a large degree, we can absorb it better than in less developed second and third world countries. And when you get high food prices, you get political unrest. Now, this graphic, which is the FAO World Food Index, goes back to the early 60s. And there have been a couple of peaks in it, and it tracks both nominal and real inflation. What's the difference? Nominal is the stated index, and real is inflation adjusted. And right now they're tracking identically. They're right on top of each other. The last time we had food prices this high was in 2011. And in 2011, we had the Arab Spring. And the Arab Spring was when we had an incredible upheaval of governments in the Middle East. Libya, Egypt, Lebanon, so much of North Africa and the Middle East was in turmoil and still really hasn't corrected itself from that point in time. That's an unrest that happens when food prices get high, and we're in that zone today. So Ukraine, Russia is a big impact on some of these rising food prices, and there's some other drivers as well. So global unrest is on high alert with nations around the world. Let's break that food index down a little bit because it's not all classes of food. The runaway prices are in oils, vegetable oils, palm oil, soybean oil, sunflower oil, canola. And those are the runaway prices. This index indicates that it's about 2.5 times what it was 6 or 7 years ago. Oil is a major base food product across the world. Cereals are up about 1.7 times what they had been in that baseline. Dairy, a little less than 1.5 times. So it's, even though we've had higher dairy prices, it's not as stark as it is in oils and the cereals, meaning wheat, barley, rye, and oats. And then sugar and meat are up, but only about 20% from that baseline level. So not quite the levels that we'd seen in other areas. Here is a look at what happened with inflation with fertilizer. And fertilizer is directly tied to energy, and in this case, some sanctions as well. So you can see USDA has pulled together fertilizer prices. These are nitrogen fertilizer prices, and they're 2.5 times what they had been just a year or year and a half ago, and that's being felt at the farm level. I'm going to break that down a little bit better. University of Illinois Farm Doc Daily had a report just this week, and I thought it was very interesting looking at the percentage change in inflation. I started the conversation today talking about the CPI. Another name for that is the PCE, personal consumption expenditures. And you can see on the left side of this chart, it's at 6.4%. And then you can compare various components as to where the ag sector lines up with kind of that core rate of inflation. All production items, so essentially what it takes to produce agricultural goods is 15.6%, but some items are significantly higher and some are significantly lower. I think this chart is really deceiving because with anhydrous ammonia fertilizer at 179% inflation, it skews the range of these inflation rates. Because if you look at all production items at 15.6% versus 6.4% kind of core inflation, it means the ag sector is running about 2.5 times what the core level of inflation in the economy is. And that is a significant headwind for the ag sector. The fertilizers are the big items in here, and fuel. Diesel at 47% inflation rate year over year, but supplies and repairs, machinery, building materials. I mean, all the headline numbers the last couple of years are, what is steel, what is lumber, and that has an adverse impact on the ag sector. So when Zach was walking through the dairy margin coverage, it's a component of milk price and expenses. They're both up. Fortunately, the price has been up a bit more than the expenses. Question mark is, how long is that going to last? So let's shift gears. That's inflation. What does that mean? How can we tame this inflation? How can we start bringing this down? One of the major levers is through the Federal Reserve, through the Fed funds rate. And I know this is a bit of a difficult chart to see, but it's called the dot plot. And the dot plot is all the 12 Fed governors have a vote as to what they think interest rates should be on a go forward basis. And they're going to have a meeting next week. And it's likely that the Fed is going to raise rates by 0.5%, by 50 basis points or 0.5%. But this dot plot is their estimates of each of the Fed governors over the next several years and longer term. So let me break it down. 2022, I think this tells us a couple things. One, there is not great consensus inside the Fed as to what rates should be. The range in 2022 ranges from about 1.5% for that Fed funds rate to 3%, with the average at 2%. So it's kind of clustered around 2%. Right now, the Fed is at about 25 to 50 basis points. So with a 50 basis point move next week, that number for May will be 75 to 100 basis points. And then they're expected to continue. So by the end of the year, you're going to get up into that neighborhood of about 2%. This was as of the last Fed meeting in March. Next year, continued rate increases. The range gets a little bit tighter, but it's still quite a bit of disparity between 2 to 3.5% from the Fed governors, and that average at about 2.5. So we'll see. The good news here, if you look out on the right side of the chart, there's more consensus that they can get their arms around, and inflation will come down a bit, and they can bring long-term rates at a bit lower level than they're likely to be next year or into 2024. So estimates are about 2.5% will be that Fed funds rate. So that's what the Fed governors are saying, and these numbers change every time they meet, but it's a pretty good indication of where they are. Here's another way to look at it, and our capital markets group puts this together, and it looks at the current and historical swap curves. And what are swap curves? They are the market's estimate as to what interest rates are likely to be from today out to 30 years. And there's 3 lines on this chart. I'm going to start with the light dashed line, which is the bottom line in the graphic. And you can see that you had a normal upwardly sloping yield curve where interest rates at the front end a year ago were near zero. And over time, you get out into 10 years, it was about 1.4%. You get out to 30 years, it was about 1.6%. So that means that the markets thought at that point, we're not going to have a lot of inflationary pressures, because keep in mind, the Fed likes a 2% target inflation rate. So if you've got long-term rates that are at or near or below that, that means that the markets aren't anticipating you'd see that change much. Then let's go into a month ago, which is the darker dashed line. And today, this was as of Monday, you can see a very steep increase in interest rates. That corresponds with the Fed increasing rates at the short end of the curve. But the market still doesn't think long-term inflation rates are likely to get out of control. We're not likely to see 1970s, 1980s types of inflation rates in the long run. So the yield curves are increasing significantly at the short end of this curve, and at the longer end of the curve, not so much. So I think that is, here's another way to look at it. This is just a table that takes a look at what the 2-year out to 30-year rates are, and what the weekly change was in the middle column, and the annual change year over year. And you can see this is where the short end of the curve, the 2-year rate, up 2.56% from what it was a year ago, versus you go out to 10 years or even out to 30 years where it's up half to a third of that amount. So what that's saying is longer term fixed rates are up from what they were a year ago, but they're not up as much as the short term rates are. So keep that in mind when you're considering your interest rate mix of debt, short, intermediate, and long term. One last comment. I think maybe I got a couple more comments about interest rates, and this is a key one. The Fed is expected. This came out last week after the Fed Chairman Powell spoke and indicated that they're likely to raise rates 50 basis points at their meeting next week. This gets them above. I talked earlier about nominal versus real rates. This gets them back above to where the real rates and the nominal rates are equivalent. So really what this graphic says is at least in the longest terms, they think that interest rates by doing this tightening, rates have come up enough so that at least it's back on an inflation adjusted basis that we will be back with real yields above zero. And that's important because prior to that, you can look at the past couple of years. It's been a negative return if you've been investing in the bond business. All right, let's switch gears and talk a little bit about the ag sector. We've talked about inflation. We've talked about interest rates. What does it mean? Here are some factors I think that are really an important component of what's going on in the ag sector. And I apologize. I know this is a busy slide, but I just have tried to cram a dashboard together as to what. And I'm going to talk first about supply and demand. And we'll talk some about the markets and wrap up with the ag landscape. On the supply and demand side, weather has an outsized impact. And we've had La Nina years, the last 2 years in both North and South America. You've had back-to-back drought in South America. That's reduced supplies. You'll see the graphic in the upper right is the drought monitor as of last Thursday. And you know, if you're west of the Missouri River, it's dry. If you're east, not so much. I know that we got a few dry pockets in the southeast and a little bit in Iowa and southern Wisconsin, but for the most part, there's a big moisture line. And when I look at this chart, I say, okay, that means that we're going to reduce our cattle herd and we're going to have less wheat production. Those are the big drivers, I think, that I see out of here. But here we are, we're in planting season. Zach and I were talking before the meeting started, and it's cold. I'm located in Wisconsin. It's cold in the upper Midwest. We're already behind planting. It's not critical. It's not significant yet, but it's cold. And from what he said, the same thing in the Northeast. So that is going to be a driver when we already have tight supplies of commodities. We've got Black Sea uncertainty. Ukraine and Russia supply a lot of Middle East and Africa. I talked earlier about high food prices, that some of the most vulnerable places in the world were being supplied out of Russia and Ukraine. And so that is going to be a real question mark on the supply and demand side of things. The U.S. acreage mix this year, USDA says we're going to have more beans and fewer corn acres. So that'll be an interesting component. And Zach already talked to you about dairy. I'll talk a bit about that more in a minute. On the markets, increased trade risk, no doubt. Russia, Ukraine, and don't forget China, Taiwan. That is the next hot zone to be watching, I think, around the world. China's been a big buyer of ag commodities, grain, oilseeds, beef, dairy, all of the above. I'm not going to be able to get a lot into the strength or weakness of the dollar, but in agriculture, we like a weaker dollar because it makes our goods more affordable for export purposes. The dollar's been strengthening. Why is the dollar strengthening? Because of uncertainty within the world. And when you have uncertainty, you flee to safety, and the safety is the US dollar. Transportation challenges are huge. It doesn't matter what kind of transportation. We have backlogs at ports. We have lack of rail cars. We've got truck challenges. Supply chain is clogged all the way through. It's going to take a long time to unclog it. One of these government policy items, we're going to see more renewable diesel, and that is increased oilseed demand. Renewable natural gas. We're talking with a number of our dairy clients about renewable natural gas projects and livestock methane digesters. So that can be an additional revenue source, certainly something that people are looking at. And the final comment on the market side is we've got changing consumer tastes, preferences, and channels. If the pandemic taught us one thing, it's that you don't need to necessarily go to the grocery store. There are other ways to access goods, and we've tried different things. In a lot of ways, dairy was a big beneficiary of the pandemic because people learned to cook and bake at home more than they had in the past. And then the final comment on this slide, and then I'll wrap through a few more comments about the ag economy, is the ag landscape. We have higher commodity prices. That has had positive and negative impacts across the ag sector. And my question is, having been in this business for almost 40 years, how long will it last? These cycles always have a timetable to them. I think we're going to have higher prices for a while, but typically what happens is you'll see prices received decrease before expenses, and that creates margin pressure. So staying on top of your risk management, I think, is going to be a key component going forward. Producer and ag business consolidation continues. I know Zach's last webinar talked some about the fewer dairy farms across the country, and it has decreased across the country, except maybe Texas. I think they may have seen an increase, or in South Dakota. But otherwise, the rest of the country has had fewer farms. And it's not just dairy, it's in hogs, it's in beef, it's in crop production. Part of that is an ownership and a management transition. And then a few other things to keep your eye on are alternative meat and dairy products. I talked about changing consumer taste preferences. That's a component of it. And the last comment here is that farmland values have increased. I'll talk a bit more about that. I got a graphic on that in just a minute. And that's positive because it's the bulwark of the farm balance sheet. Farm income expectations. This breaks the country down and it compares net cash farm income estimates from USDA for 2022 versus 2021. The Northern Crescent is a heavy dairy area, and that's why you see it leading the pack at 16% improvement in net farm income. That, again, is a component of milk prices being higher than expenses, even though both have increased this past year. So I'm going to break the world into a couple of areas, and I'd like to break it into things that grow and things that eat. And I'm just going to hit on a couple of them. Corn is the big driver because energy in the dairy ration is a big component, and that's what is happening with corn prices. Here you see a candle chart which indicates the change in price for the May core contract going back to about the first of the year. And a green candle is an up day, a red is a down day, and there's more green than red in this graphic, and it's been upwardly sloping. And why is that? Well, those weather issues I talked about, dryness in South America and dry in parts of the US and too wet and cold in other parts of the US. So we're slow in planting, and that's one reason you see this popping up. Ethanol production, the most recent pop-up when the Biden administration announced a 15% ethanol blend for the summer blend. Markets said, okay, that's bullish for corn, increase the price. Corn is fighting with soybeans for acres this spring. The headwind here are fertilizer chemical prices. They're skyrocketing. In some cases, you're going to have availability. What we've heard from most of our clients is they got their fertilizers, but their chemicals may not, they got them, but they may not be in the form that they normally would have. Maybe they got a dry product instead of a liquid product and have to mix it. So that's a big component of corn prices. Soybeans have trended the same way. It makes some sense because soybeans are fighting with corn for acres right now. The other item that's impacting soybeans is the increased amount of biofuel, renewable diesel that's coming out of that market. But the biggest driver by far has been poor yields in South America, Brazil and Argentina and Paraguay in particular, due to drought. Why will some acres shift from corn to beans? Because if you don't have nitrogen fertilizer, you don't need as much for soybeans as you do for corn. And so you may see some acres get shifted in that regard. So those are the expense side. Now let's shift to the things that eat, and that's on milk, class 3 milk. In our core market in the upper Midwest, we're heavy class 3 users, so I tend to look at class 3. And it's right now, if you look at the futures market, as of close of yesterday, 23.34 per hundredweight, which would best 2014, which is the highest milk price ever, at 22.26. So a little over $1 higher this year than last year. I will just throw this anecdotally out there, but what happened in 2014? In 2014, Russia invaded Crimea and took Crimea away from Ukraine. So we got a little rhyming situation. Russia again is back into Ukraine. We have higher milk prices. Milk prices crashed in 2015 following that invasion because of additional sanctions being put on Russia, and that took one of the major milk buyers, one of the major dairy product buyers, out of the market. You're not expected to see that this time around, but if China does something with Taiwan, keep an eye on that. That would have an adverse impact on milk prices. I'm not predicting anything. I'm just saying that's a risk that's out there. Also driving dairy prices higher are, again, back on demand and supply. We have got good domestic demand. Zach did a great job of walking through that. And our exports are up. Why are exports up? They're up because our major competitors, the EU and New Zealand, are down in milk production. And they're down in milk production for a couple of reasons. They're down because of dry weather. They're down because of higher feed costs in the EU, and some climate-related policies that both the EU and New Zealand have adopted, which is reducing the amount of animal agriculture. So all of those kind of are converging, and we've seen milk prices moving higher. Higher feed and other input costs will continue to squeeze dairy margins. I think the DMC is a great barometer as to where profitability is at the dairy farm level, and it's significantly better in 2022 than it was in 2021 when we had DMC payments every month of the year. So just wrap up with a couple of thoughts just to reinforce the comments I was making. Looking at soybean oil supply and demand, this is USDA, and they're estimating the bar chart. At the bottom of the bar chart is the amount of soybean oil expected to go into biofuels, renewable diesel and biodiesel, and that is the big demand increase expected. And that means we need more beans in order to produce that type of fuel, and that's driving soybean prices higher. Milk production from our major exporting countries. This is from U.S. Dairy Export Council, and I look at this because there's a very high correlation between milk prices and milk production changes. And you see that Europe, which is the red bar, is down substantially in milk production on a year-over-year basis. This was through the end of the year, so it's through December. And no wonder we've seen milk prices move higher, because there's just less supply in the world. That has been trending that way for a while, and that I think is going to be bullish for milk prices in the U.S. For a while. Last comment I'll make is on farmland values, and I picked the 7th Fed district, which is the Chicago district. That's where I live, but it encompasses much of Illinois, all of Iowa, southern Michigan, southern Wisconsin, and Indiana, or most of Indiana. And you'll see that farmland values have been moving up higher every month since the beginning of 2020. You'll see a period from about 2014 through 2020, where they bounced around either side of no change, had some reductions earlier in that period, and then it's increased significantly. So that's good, because it provides an equity base for some adversity should the economy need it. So just to wrap up, inflation's been running hot. Will it cool off? The Fed can't do a lot about some of the inflation issues. They can increase interest rates, which will reduce some demand, but that doesn't fix the supply chain. That doesn't change the sanctions of impacting core commodities because of the war in Ukraine. So the question is, how soon will inflation cool off? And it really is not going to cool off until we fix a lot of the supply chain issues. Higher energy costs drive higher food prices, and that increases world instability. And that's something to keep an eye on. However, markets as a whole expect inflation to moderate in future years. So we're going to have high inflation for a period of time, but eventually we'll get things back into control, under control, and you'll see inflation moderate. Supply chain challenges converge with demand moving commodity prices and cost higher. So again, back to that supply chain issue. And I think the question mark is, we know prices and costs are going to correct downward. Question is, which one happens first, or will they happen in tandem? And interest rates, they're going up, especially on the short-term side. As I mentioned, on the longer-term side, they've gone up, not as much as on the short-term side. So your variable rate debt is going to be much higher priced over the next year. And it is probably a great time to be looking at trying to fix some interest rates and take some of that risk off the table. It's not too late, because the longer-term rates haven't come up at the same rate as short-term rates have. And then the last comment is that trade has an outsized impact on ag markets, and it's important to watch global hotspots, because that is a key driver of what's going to happen to ag markets, and it can happen in a hurry. So with that, Zach, I'll open it up to questions. I do see there is one in the chat box. Maybe I'll just start with that. What advice would you give a dairy farmer in Florida? Oh boy, that's a great question. I mean, the good news is you've got a fluid milk market in Florida. The challenge is going to be on the feedstuff side because of the cost of getting energy and protein into the markets. So you're probably going to track more of that class 4 market than the class 3 market would be my guess. But I think there's a shortage of milk in the Southeast, and that should be bullish for prices in that particular market. Zach, I don't know if you've got some thoughts to add.
No, that's covers it pretty good, I guess, from my end. There's not any more questions in the chat. If anyone does have a question you want to unmute yourself and ask, that's certainly okay with me. I will ask to give some people more time to think about questions, or maybe send one in a chat. You say that this 50 basis increase in interest rate, from a standpoint of well, usually in years when milk price is good, you see expansion in the dairy industry pretty quickly, and I'm sure rising interest rate is going to dampen that a little bit. But what's your feeling on, as these interest rates increase, what effect is that going to have on the ability of the U.S. dairy industry to expand?
Yeah, that's a great question. I normally we were on this cadence where every 3 years milk prices would go up. It'd be very good years, and then you had an average year and then a poor year, and then the cycle would repeat. And normally when you have higher milk prices, that would spur expansion. There's a couple major governors on the ability to expand right now. Rising cost is a major one of them. if you've priced out anything with regard to buildings or equipment, that's going to put you on pause just from adding that added overhead. Number one, if you look at our young stock, the heifer replacement inventory, it's the lowest it's been in a decade, and that's another governor on the ability to expand. A third one are the base and quota programs that many processors have. And why do they have those programs? Well, they have them partly because of plant capacity, partly because of labor challenges. Labor is an issue all across the economy. And there are some processors that can't ramp up capacity because they just don't have the people to be able to produce additional product. So you've got a few major headwinds towards seeing a significant amount of expansion. And I'm not anticipating that we're going to see a lot in the country.
There was another question that came in with pressure for changes in the federal milk marketing order pricing system. How do you think this might affect future milk prices?
Yeah, that's a great question as well. I attended the IDFA Dairy Forum earlier this year and participated in a panel that was talking specifically about that. And there's good news and bad news on federal milk marketing order reform. The good news is the Secretary of Ag has great background in dairy, Secretary Vilsack, and he has said, industry, come up with something and we'll push it through. So that's the good news. The bad news is what's best in Florida isn't the same as what's best in Idaho or Wisconsin or Texas or California or Pennsylvania. And so getting the industry to come together and converge is really what the challenge is. And I know there's a lot of discussions going on at this time regionally around the country, but I just don't know if we're going to be able to come together as an industry and get something done. So I think that's the question mark. I think we really saw the impact of the last reform, which seemed like it made a lot of sense. Changing the formula price to be, instead of the higher of, the average plus 74 cents. That didn't work out so well. I know within our portfolio, we had customers in some of those months that had pay prices over $6 a hundredweight difference, and that made a big difference. It really separated who you were shipping to and whether they were participating in the order or not. So there's certainly the desire to get something done. I just don't know if we're going to get all the constituencies together to get on the same page.
I read an article just yesterday, or part of an article that came through on a national milk email I get, and with Vilsack saying that he's happy to push reform, but the industry has to come to some agreement on what that reform looks like. I think probably one of the worst things we could happen is to have another issue and do away with the federal orders because it didn't pass. So this agreement is an important thing, and there are some things that the milk marketing orders, I know the system doesn't work the way it intended originally, and because of different dynamics in the market now, but there are some important things that the milk marketing orders do that I don't think we as an industry want to see them go away. So it's going to be a challenge, but hopefully we can get somewhere to a place of agreement across National Milk and IDFA and dairy farmers and all those players involved. So any other questions? I'm not seeing any more in the chat box. I'm looking at the Facebook live stream as well, and there's nothing there. So if there's nothing else, let me, I just have a couple more comments. So first of all, thanks, Sam, for being with us today and being part of our Protecting Your Profits webinar today. I appreciate your time, appreciate your willingness to be on the webinar and provide the information that you did. Very good information and very informative and timely. But this is recorded, so I'll be sending the link out here as soon as the recording is ready. So if there's something you want to go back and review, please do so. That will also be available later on today or tomorrow morning as a podcast on Spotify or Amazon Music or Apple Podcast. So please use those resources if you need to, and for review. And the next Protecting Your Profits webinar will be next month, May 25th at noon, as always. And next month will just be the normal review of the USDA reports and markets and risk management. And with that, again, if there are any questions, now's your last chance, and that ask you to participate again next month, and appreciate you being here, and look forward to talking with you again next month. All right, thank you, Sam, and thank you everyone again for participating, and I hope you enjoy the rest of your day and the rest of your week. Hopefully it'll warm up soon.
Thank you.